Stock multiples. How to tell when a stock is cheap or expensive? Investors in the stock market use stock multiples to determine how much a particular stock is worth compared to other stocks. Whether you want to know if a stock is overpriced or underpriced relative to others in its industry, you may use a stock multiple. A wide variety of multiples are accessible by mathematical calculation. The ratios are found by comparing the current stock price to a particular financial metric for each share. In this video, Omega Finance will show how stock multiples help investors and analysts measure a stock's worth. You will know all the ratios to measure a stock's value, including the price to book PB ratio, the price to earnings PE ratio, the price to earnings growth PEG ratio, and the dividend yield. We will also show you some of India's 2022's expensive and cheap stocks. So stay until the end of this video so you don't miss any important information.
Audio Jungle.
What are stock multiples? The word multiples is often used to refer to a large group of ways to measure the value of a stock. A multiple is a ratio found by dividing an asset's market or expected value by a specific line item on the financial statements. The goal of the multiples approach, which is a comparative analysis, is to value similar businesses by using the same economic factors used to value the original companies. Analysts often say that a particular ratio can be used to compare and evaluate enterprises in the same market category when using the valuation method. When two businesses are similar, the multiples method can determine how much one is worth by predicting how the other will do. The multiples approach aims to figure out how much a company or its share are worth by multiplying a particular financial statistic, like earnings before profit and taxes, EBITDA, by a single number that considers several operational and economic factors like expected growth. When is a stock too expensive and when it is too cheap? The price may be the most critical factor when deciding which stocks to purchase. However, a stock's cost and worth are two different things. Looking at a stock's worth might help you determine whether or not the price is fair. You may use this information to decide whether or not to put money into it. The price of a stock is easy to find out. However, knowing its worth involves additional nuance. Nonetheless, it's not out of the question for the everyday investor. Earnings per share EPS, price to earnings PE ratio, and price to growth PEG ratio are the big three metrics for valuing a business. Let's find out more about them and how they may aid you in making sound financial decisions. What are the four key components that determine stock prices? Four fundamentals in investing are used to determine a stock's worth. These are the four well-known financial numbers and what they can tell us about a stock. The price to book PB ratio, the price to earnings PE ratio, the price to earnings growth PEG ratio, the dividend yield. Financial ratios may be a valuable analytical tool better to understand a company's financial records and overall health. The price to book PB ratio. The price to book PB ratio is the worth of a firm if it was to be ripped up and sold today, and is thus helpful for those with a pessimistic outlook. This is important because many businesses in established markets have slowing growth, but based on their size and quality of assets, they may still be a good deal. Assets like machinery, real estate, and tradable securities like stocks and bonds are all included in book value. Since their assets are marketable goods, the book value of pure financial companies can go up and down with the stock price. Generally accepted accounting principles say that a firm's book value is often based on the tangible assets written down each year. A low PB ratio will shield you in either scenario, but only if you can trust it. The investor needs to learn more about the assets used to calculate the ratio. The price to earnings PE ratio. Perhaps the most examined of all ratios is the price to earnings PE ratio. Stake is the price to earnings ratio, whereas sizzle is the quick spike in the stock price. Stock prices can go up even if profits don't go up at the same rate, but the PE ratio will tell you if that trend will continue or not. A stock's price will inevitably define if gains don't support it. Remember that comparing PE ratios across sectors and marketplaces is not good. If nothing changes at the company, the PE ratio shows how long it will take for an investor to get back the money they put into stock. If a company is selling for $20 and making $2 per share, its price to earnings ratio is 10, which is commonly interpreted to suggest that investors would get a return on their investments in 10 years. Assuming nothing changes, stocks often have a high PE ratio because traders are betting on which companies will see rising profits. If a stock's gains are expected to double annually, an investor may be willing to pay a PE ratio of 30 for it. The stock's price to earnings ratio will return to earth if it doesn't. If the company can double its profits, its stock price is likely to stay high. The price to earnings growth PEG ratio. Many investors use the price to earnings growth PEG ratio in place of the traditional PE balance because of its greater predictive power. In addition to looking at the current price and profits, the PEG ratio also considers the earnings growth rate over the last several years. This ratio also compares the value of one company's shares to another, so you can see how A to B measures up. To get a company's PEG ratio, divide its PE ratio by its profit growth rate from the previous year. The lower the PEG ratio, the cheaper the stock is compared to how much money it is expected to make in the future. Investors can use the PEG ratio to compare the prices of two companies to figure out which one has the lower cost of growth. If growth rates remain constant, a PEG of 1 indicates financial stability. As an investor, you should know that if a company's PEG is 2, you are paying twice as much for predicted growth as you would for a stock with a PEG of 1. There is no assurance that growth will continue at the same rate as in the past, making this a risky bet. Comparing the PE ratio to the PEG ratio is like looking at a picture and a graph of the company's history. An investor may use this data to determine if the trend will persist. The dividend yield. When the rise of a stock slows, it's comforting to know that you have a backup plan. Many investors choose companies that pay dividends because they continue to provide income even if the stock's price falls. The dividend yield can determine how much of a return you will get on your investment. You can get a rough percentage by dividing the stock's annual dividend by its current market price. Think of that percentage as profit on your investment, with the chance of more growth if the stock increases in value. Although the dividend yield seems straightforward, there are a few nuances to remember. You can't count on the dividend yield because payments have been inconsistent or stopped in the past. When deciding whether or not to buy a stock, it is essential to know the direction of the dividend tide. For example, it is important to know if dividend payments have grown yearly. Utilities and certain banks, for example, are known to give out hefty dividends to their shareholders. In contrast, technology companies often reinvest most of their profits to drive future development. Let's have a look at some of the most expensive stocks in India to invest in 2022. Number 1. MRF. Price-wise, it is the most expensive stock in India. As of October 21st, it was trading at 86,002.05 Indian rupees and had a PE ratio of 52.68, much higher than the industry average of 46.90. It is the most expensive stock ever sold in India. MRF shares are costly because they are never split and always have a face value of 10 Indian rupees. MRF has given returns of 30.5% over the past 5 years. The 52-week low and 52-week high prices for MRF shares are 63,000 Indian rupees and 89,499 Indian rupees. Number 2. Page Industries. Page Industries Limited is in the textile business. It makes and sells the Jockey brand in India, Sri Lanka, and the United Arab Emirates. For 2022, the company's annual revenue growth of 36.99% was better than its 3-year CAGR of 10.48%. It is the most expensive textile stock in India. As of October 21st, it was trading at 52,936.25 Indian rupees with a PE ratio of 74.62, while the average PE ratio for the textile industry was 48.91. It has been a multi-bagger stock with returns of 187% in the last 5 years. The 52-week low and high share prices for Page Industries are 29,950 Indian rupees and 50,350 Indian rupees. Number 3. Honeywell Automation. Honeywell Automation India Limited is a part of the Honeywell Group in the United States. It makes electronic systems and parts, fixes and maintains them, trades machinery, equipment and supplies, and does repair and maintenance work. Honeywell Automation sales have grown at a rate of 4.36% per year over the last 5 years, while the average for the industry as a whole has been 8.99%. The company's quarterly sales increased by the most in the past 3 years and gained 17.62%. As of October 21st, it was trading at 37,809.75 Indian rupees and had a PE ratio of 103.99, which was much higher than the industry average of 25.32. It has given a 207% return over the last 5 years. Honeywell Automation share prices have been as low as 30,185 Indian rupees and as high as 47,275.95 Indian rupees over the past 52 weeks. Let's have a look at some cheap stocks in India to invest in 2022. Number 1. Vodafone Idea. Vodafone Idea, often shortened to V, is an Indian telecom company formed when the Aditya Birla Group and Vodafone Group joined forces. It offers data and voice services on 2G, 3G, 4G, and 4G Plus network. Its price is currently around 9.75 rupees, close to its 52-week low of 7.75 rupees. Number 2. Finolex Industries Limited. Finolex Industries Limited makes more PVC pipes than any other company in India. The company was started in 1956 and its products include PVC resin, PVC U-pipes and fittings, self-fit PVC U-pipes for agriculture and potable water supply, ring-fit PVC U-pipes and more. The company's market cap is 9,086.52 crore Indian rupees and its EPS has grown by 24.26% over the past 5 years. It has an 8.64 PE ratio. Number 3. Muthoot Finance Limited. Muthoot Finance Limited is the biggest non-banking company in the country that offers gold loans. The company was started in 1939 and had a market cap of 41,498.55 crore Indian rupees and had a 5-year EPS growth of 27.21%. The PE ratio for it is 10.33. Number 4 is CC Securities Limited. CC Securities Limited is an integrated securities firm offering a wide range of services, including investment banking, institutional broking, private wealth management, and more. The company was started in 1995 and had a market cap of 17,771.77 crore Indian rupees and a 5-year EPS growth rate of 32.47%. The PE ratio for it is 12.85. Using these methods to appraise a stock offers you a comprehensive picture. Creative accounting may modify these and even more difficult statistics like cash flow. As valuation resources increase, contradictions become increasingly apparent. Even if hundreds of other measurements become more important, these 4 key ratios will always be an excellent place to start when figuring out how much a company is worth. So we hope you got the idea about finding the actual value of a stock. In the end, please subscribe to this channel and press the bell icon if you're new to the channel so you don't miss any new stuff.